What is up, everybody? Crypto Noah, aka your favorite blockchain entrepreneur, back with another fire video. And before we get into it, I would ask that you strongly consider hitting that like, subscribe, and bell notification button, as I'm trying to bootstrap this channel from zero, and it would greatly help us out here. So this video is going to be really important, and the goal of this video is to give you a great macro understanding as to how the economy works and how it's going to affect crypto in the short term. So I'm going to show you why I think we are due for another 15 to 30% correction in the stock market. And I'm going to show you how I came to that conclusion, back testing the charts all the way back to the Great Depression, and why I think we're going to see at minimum 14 to 15K Bitcoin and still have some way to go down on ETH, as well as how I am playing this strategy to make money off of this current situation. So let's get right into it. So the first thing that we're going to look at before I even break the charts open is Fibonacci and the golden ratio, because it has a lot to do with this. So real quickly, I just want to go over a few things here with you. So what is Fibonacci? It's nature's ratio. It says here there's a unique ratio that can be used to describe the proportions of everything from nature's smallest building blocks, such as atoms, to the most advanced patterns in the universe, like large bodies. Nature relies on this innate proportion to maintain balance, but the financial markets also seem to conform to this golden ratio. And it says here the golden ratio is derived from the Fibonacci numbers, a series of numbers where each entry is the sum of the two preceding entries. And it talks about basically how Fibonacci is used in nature, art, and trading in financial markets. Let's read a little further here. So examples of the golden ratio. Honeybees, for example, if you divide the female bees by the male bees in any given hive, you will get a number around 1.618. 618, we've talked about that a few times here. Sunflowers, which have opposing spirals of seeds, have a 1.618 ratio between the diameters of each rotation. The same ratio can be seen in relationships between different components throughout nature. It appears in the arts, of course, because it's more aesthetically pleasing. I'll show you some pictures on that as well. And it also works in finance. The golden ratio is frequently used by traders and technical analysts who use its forecasts market-driven price movements. This is because the Fibonacci numbers and the golden ratio have strong psychological importance in herd behavior. Traders are more likely to take profits or cover losses at certain price points, which happen to be marked by the golden ratio. So they talked about how you can, and again, here's that 161.8 number, or 61.8, and this is what I'm going to show you guys on the chart. They're about to talk about how Fibonacci can be used on a chart, but they don't show what I'm talking about. So you're in for a secret, so keep watching. 4 ways you can use Fibonacci, 3 or 4 ways. The one is Fibonacci retracements, which I have used. The second one is Fibonacci arcs, which I've never used. Fibonacci fans, which I've never used, and then Fibonacci time zones. And then just a little bit more info on this. So it talks about where have we seen the golden ratio? Our bodies. The ratio from the distance from the top of our head to our belly button to the distance of our belly button to the floor is in the golden ratio. Hopefully I said that right. Flowers. Take a look at a sunflower next time you see one. It's said that these flowers grow in the Fibonacci sequence number. Architecture. A lot of historical buildings were built using this golden ratio. The Great Mosque and Carrion are some examples. Please forgive me if I mispronounce that. And then paintings. And then I'll just go over some pictures here. Now, I really want to hone this in because this is like the language of the universe. And if it's true in the universe in biology, that's technically financial markets as well, because we're a part of the universe. So these are just some pictures as it pertains to nature. And it's like you can't unsee it now. And I've been, looking into Fibonacci for a while. And if you look at it as it pertains to art, same thing. You see it have here on the Mona Lisa, this famous painting here. You pretty much can see it everywhere. So now, I don't want to bore you guys to death. Let's get into the chart. So I said at the beginning of this video that I think we're due in the stock market for at least a 15% correction. On the higher side, a 30% correction. Why do I believe that? Let's take a look here. So right now, we're still in this downtrend. By the way, this is the monthly chart, so each candle represents one whole month. We've been in this downward channel, right? Just bouncing off the top and the bottoms of this, and we just wicked off of our 200-day moving average, and it looks like we're about to make our way down. So why do I say 15%? Well, this orange line here is what's called the 62 EMA. So remember, the 61.8 is the golden ratio, or the 1.618. So by using the 62 EMA, you're off by 0.2 points, but you can't use a 61.8 EMA, so it's as close as you can get. And then an EMA stands for estimated moving average, which is just the average of the previous 62 candles in this case. If it was the 50 EMA would be the average of the past 50 candles. And that goes for if it's the minute chart, the hour chart, the 4-hour chart, the monthly chart, the weekly chart. It's the average of past however many candles on whatever that time zone is. So for the monthly, we're looking at the average of the past 62 months. So you want to think of this line as rolling Fibonacci, right? And the reason why I say that I think we're due for another at least 15% correction is because I think we're going to come back down to this 62 EMA at minimum, And I say at 30 because I think it's going to be between 20 to 30 if I'm being real with you. So now, this is where we would be on a 30% correction. So now if we back test this, right, I'm going to show you that through every recession, depression that we had, going back to the Great Depression, the market has always came back to the 62 EMA before things started to go back up. So now here we are, November of 1929, Great Depression. Okay, so here we are all zoomed in. This is the roaring 20s here. And we're back so far that the candles aren't even green and red anymore. They're just these green little dots. But this was the roaring 20s here. We went up and up, and then the Great Depression happened. Boom, and we experienced a bear market for like 3 years. But if you notice, we went well under the 62 EMA before we eventually bounced back. Same thing here with the recession of 1937. We went up, and we came back down below the 62 EMA before we eventually got back over it. And then now we're getting back closer to the modern times, at least. So now if we go to June of 1970, same thing. We were in this bull market, and then the market dipped below the 62 EMA before things got bullish again. Same thing here in 1974. We were going up and up and up from 70 to around 73, and then we had this bear market. Got below that 62 EMA again. Same thing here in 1982. We're in this bear market or this bull market, came back down to the 62 EMA before things start to shoot back up. And now we see the stock market starting to go parabolic. And now here we are, 87, the real estate crash. Had this beautiful bull market crash and wicked right down to that 62 EMA. We're actually down there for around 3 months. It visited and revisited. And again, this is the monthly chart. Going forward, now here we are in the 90s, and this is the dot-com crash. So we went up, and then the dot-com crash happened. Boom, we slammed down below that 62 EMA, and we were actually down there from August of 2001, and we didn't get back above it until December of 2003. And then we went on the bull market for years up until 2008 happened, and we went well below that 62 EMA, and we were down there from January 2008, and we didn't get back above it and stay above it until December 2011. So now, going to even more current times, I just want to overwhelm you with this data, and this happened every single time, every single crash, as you can see, and this is the S&P 500. COVID came down below the 62 EMA, wicked off of it, was there for 2 months, and now we exploded again, and we are fresh off the longest decade that we've ever had without a crash. And we just printed the most money that we've ever printed throughout history combined just within 2 years. So now it would be very, very naive to think that we're not at least going to come back down and touch the 62 EMA. I'm calling that we're going to go below it and at least go back to pre-COVID COVID levels, which is around here. So now that we have that, it's the same thing for the Dow Jones, which is going to be the strongest index because it's the top 30 companies. Same here. March 2020 came below the 62 EMA, and even during 2008 came below it again, and even during the dot-com crash came below it again. It's the same thing with the NASDAQ as well, pretty much with all indexes. The proof is in the pudding. So now let's look at Bitcoin and Ethereum. I'm not going to look at all the altcoins because where Bitcoin and Ethereum goes, the rest of the market follows. We all know that, especially if we've been in crypto for, some time. So I said I think we're going to see a 14K Bitcoin. Now let's look at this. This is the monthly chart again. So this box right here is my accumulation channel. Like I'm going to start accumulating heavy once Bitcoin gets within this box. So we've been in this falling wedge pattern, just been knocking around from this channel to this channel, just going up and down, touching it. And I think we're going to get one more touch to the upside. I think with the ETH 2.0 narrative, we'll probably rally up to around 24, 25K before we drop back down to around 14, probably consolidate for a while. And a hint that I would look for that we're bullish is for me to see us consolidating in here like that, And then I want to, like I said, when I used to trade Forex, the rule was no retest, no entry. I want to see a break and a retest off of this line here, turn this resistance into support, print a nice big green candle, and then I would get in right around here. That would tell me that things are bullish. So now let's also look at ETH. If we look at ETH monthly chart again, same thing. We've been in this channel wicking off of the tops and the bottoms of it, and we have the ETH 2.0 merge narrative. I think we're going to pump into it. For me, it's going to be a buy the rumor, sell the news kind of event. So I think we pump back up to around 2,000 before we drop to around $600 to $700. You can see we've been in this trend with ETH and Bitcoin. And if you ever been in financial markets or anything, I'm sure you've heard the saying, the trend is your friend, and the trend is downward. So don't trade against the trend. So now if we just look at the entire crypto market, we see the same thing. You know, we've been in this downward channel. I don't have it drawn here, but you can still see it. I think we come back up, turn this into resistance, and then make our way down. And you know, there isn't any relevant support until we get like around here. So we'll probably get to that $555 billion level. And I hope we do, because man, that would be some sweet discounts. Like, it would be not hard to get 10, 20, 30, 40, 50x from the bottom. So that is that. Let's talk about the current economic climate and why I feel these things, other than just looking at the chart, because it's about the fundamentals as well, especially when it comes to a market like crypto, where it's very new. So technical analysis doesn't hold as much weight as it would with the S&P, which has been around forever, pretty much. So geopolitically, there's still a war going on in Ukraine, which can still have other ramifications that we can't conceive in our mind right now. We have the Mt. Gox unlock happening, where Mt. Gox was hacked, a decade ago. I forget the exact year. I think it was 2013. And they are going about releasing 181,000 Bitcoin to people. Now, put yourself in their shoes. If you're a person who bought Bitcoin way back when, and now you're still up over 20x, and look at the current economic climate. Unemployment is up, inflation is high, things are expensive. Some of those people are going to sell, I guarantee you. I don't know what ratio it is, but I'd imagine at least 30 to 60%. I know it's a wide window, but nothing like this has ever happened. So I don't even know how you could even come up with how much people are going to sell. So I don't think the market has priced this in. So that's just going to be more selling pressure on Bitcoin. And right now, only like 7 to 10% of all Bitcoin is on exchanges. So the more Bitcoin that goes on exchanges, the more the price is going to go down. Also, we just saw on the Fed minutes a week or so ago that they are still hawkish. They are not dovish. Inflation, even though we came in at 8.1, lower than the 8.5 the month before, the Federal Reserve's goal is 2%. We still have another 6% to go. And they said that they are going to still be raising rates, even though they're going off a month-by-month basis. So that means even if inflation drops a whole percent, and it's at 7, even if it's at 6, they are still going to raise interest rates because 6% inflation is still extremely, extremely high. So I would be expecting at least another 50 to 75 point interest rate hike. And if they do that, it's going to cause a further sell-off. So let's talk about why. So the Federal Reserve has two tools on their tool belt, pretty much. Two powerful tools. Controlling interest rates. When interest rates go up, it acts as a vacuum and it sucks money out. People start investing into government bonds because when the interest rates go up, the government bond yields go up. And when interest rates go down, it makes the cost of capital cheap. People borrow money. That money makes its way into assets. And that's why when interest rates are low, we see surging asset prices. So in the beginning of a bubble, and again, we just went through the longest stretch without a recession or a crash that we've ever seen in history. In the beginning of the bubble, debts rise faster than incomes, and they produce strong asset returns and growth. And this process is generally self-reinforcing because rising incomes, net worths, and asset values rise borrowers' capacity to borrow. This is because lenders determine how much they can lend on the basis of, 1, the borrower's projected income / cash flows to service the debt that they're going to extend to them. 2, their net worth and collateral, which raises as asset prices rise as well. And 3, their capacities to lend. And all of these rise together. Borrowers feel rich, so they spend more than they earn and buy assets at high prices with leverage. And when it comes to borrowing and then spending more than you make and then having to turn around and spend less than you make, that represents a cycle in individuals as well as in institutions. So if someone makes $50K a year, but they're borrowing money and they're spending $60K a year for 2 years, well, once things start to contract, they're going to have to spend $40K a year, even though they're making $50, all else being equal. When interest rates rise, all of that, everything that I just told you, works in reverse. When the limits of debt growth relative to income growth are reached, asset prices fall, debtors have problems servicing their debts, and investors get scared and cautious, which leads to them selling all or not rolling over their loans. This in turn leads to liquidity problems, which means that people cut back on their spending, and since one person's spending is another person's income, incomes begin to go down, which makes people even less creditworthy, and then investors withdraw their capital from risky financial institutions, causing even more liquidity problems. So we just went through this economic expansion, and now we're going through an economic contraction because we printed so much money, and now we're having to suck that money out of the system. And I'm not saying that credit is bad, because extending credit and being able to prove ownership of something and then being able to borrow against it is the basis of capitalism. But too much credit is bad, just like too less credit is bad. But the price you pay is the price of foregone opportunities. So there's definitely a fine line that you have to balance between. After listening to what I just told you, it makes sense why every single recession and depression, economic crisis that we've ever went through, excluding like natural disasters, every single one of them be traced back to the Federal Reserve and them making it easy to borrow money and not having like a strict criteria that they go by. So even if we go back to the Great Depression, the Roaring '20s that happened before the Great Depression, cars became the norm and interest rates were low and people were borrowing against their houses so they can, finance their cars and their vehicles. And eventually the punch bowl got empty, and then we saw the Great Depression. Same thing in 2008. In 2008, you had the subprime borrowers. And I recommend you watch the movie Big Short. He knocked on the guy's door and was asking for, I forget his name, let's say his name's Billy. And he's like, Billy, that was my neighbor's dog. And he was like, oh man, what the heck? That guy took out a mortgage for his dog. They made it so easy for you to take out a mortgage. The places that rated the bonds, because they were taking these mortgages and packaging them together, calling them mortgage-backed securities, and they fooled institutional investors to think that they were like low risk because they were given AAA ratings. And same thing. Then everyone was getting a house, and then next thing you know, again, all of those mortgages they were getting, people who suffered, they were getting variable rate mortgages, which means that when interest rates go up, the interest on their house payment also goes up as well. So, and that's why we saw so many homes foreclosed on. So now we're dealing with that same thing, but I'm not talking about housing. I'm talking about corporate debt. Did you know that 50% of the gains in the stock market over the past decade has been from stock buybacks? Why is that? And then why is that important? Well, once a company buys back their own stock, it makes the stock more scarce, and it increases the earnings per share. But these companies were buying back their stock because interest rate had been so cheap for this past decade. They were borrowing money for the cheap, and then they just go and buy their stock or buy other assets, and that's why we saw assets go up. Well, hey, guess what? Did you know that this corporate debt bubble is 5 times bigger than the debt bubble that we saw pop during the 2008 financial crisis? Let that sink in. So with all of that I just said, it would be, in my opinion, very naive and maybe even foolish to think that the bull market's back on and we're going to rally back to all-time highs just because Ethereum is changing the way in which they come to a consensus on their network. So with that, if you want to see how I'm making money with this opportunity, click the link to my last video. I'm shorting Bitcoin and Ethereum right now in the crypto market, and my shorts are already in the green. And I'm just waiting for the market to get to my target level so I can begin accumulating more. And I'm still yield farming. So I'm accumulating these assets day and night, 24 hours a day. It doesn't matter what I'm doing. If you want to learn more about that, join our Discord, click the link below, and we'll be dropping our yield farming course here in the next month or so. And it's for sure going to be the best yield farming course, material, team. We have the top yield farmers in the world working with us. And believe me, I know because I've been through all the courses and all the groups and all the Discord. So I hope you learned something from this video. And with that, I thank you for tuning in. I love all of you, and I'll see you in the next video.